Hey everyone, good morning.
Good morning.
Good morning.
I want to welcome our viewers to our DAT IQ weekly market update. This is our update for December 8th, 2020. We will have one more show before Christmas. So we've been breaking out the Christmas sweaters, right? At least 2/3 of us.
Yeah.
Yours is a bit haunting, Ned.
It's great. It doesn't come across on camera, but there's actually like motion sensitive LEDs in the eye sockets and like the little ball. And so it's like got this flashing light thing going on that makes it just a
Well, in memory of not actually getting a deer last weekend at camp, I wore one with 2 elk on it. So
I'll be set next week. I just typed in hideous Christmas sweaters into Amazon and one popped up. I'll be set.
nice.
I believe.
Well, just to remind everyone, we're here every Tuesday. Today happens to be Wednesday. We were delayed today, but typically Tuesdays at 10 a.m. Eastern, 7 a.m. Pacific. That's where we'll be next week for our last show. I'm Ken Adamo, Chief of Analytics at DAT, joined by Ned Damon, who's our Principal Data Scientist, and Dean Croke, who's our Principal Industry Analyst. Each week we go through freight trends, take a look at our forecasts, and then most importantly, answer your questions. So go ahead and drop those questions in the chat or comments, and we will get to those as the show goes along. Past few weeks has been awesome. We've actually ran out of time to answer questions, which is always exciting because we love coming on here and answering your questions and getting conversation going. So please drop those below. And with that, I will get started with our key trends of the week. So there's a lot going on. This is one of the busiest periods of the year, especially for parcel shipping. But dry van load post 5-year record. It'll be interesting. I love these charts that Dean shows that have kind of a ordinal week of the year on the x-axis because it shows us how different holidays that how they've fallen in different years and how that affects the freight volumes. Capacity is tightening. Some very interesting trends on rates. Dipping across all 3 equipment types. Don't call it a trend just yet is my motto. FMIC October contract volumes were down, but spot markets are just completely on fire. I think that matches what we're all seeing and feeling out there. And then new COVID lockdowns add more uncertainty to the freight markets. And that's enough of me talking. I'm going to turn it over to Dean to get down to some charts and graphs.
Thanks, Ken. Yeah, this week's a little bit interesting. Last week in terms of week-over-week comparisons, I'll look back a little bit further pre-Thanksgiving to give you some comparisons about how last week's full shipping week shaped up, because we'd be comparing last week to the pre-Thanksgiving short shipping week, so the comps would be all skewed. But last week, dry van load post volumes bounced back strongly as they do. That was the first full shipping week after Thanksgiving. Compared to the 8 weeks prior to Thanksgiving, load post volumes last week were up 21% versus the weekly average of the prior 2 months. So volumes did increase to what we call record levels. Load to truck ratio moved up to 6.01. Capacity did tighten as drivers got back into the seat. But there are about 8% fewer trucks posting for load. So capacity did tighten a little bit for the first full week of the after Thanksgiving. In the refrigerated sector, the load to truck ratio returned to pre-Thanksgiving levels at 9.16. But in stark contrast to dry van load posts, refrigerated load post volumes were down 1% compared to the prior 2 months, which is definitely a sign that the market is cooling, which we typically see around Thanksgiving. So no surprise there. In the flatbed sector, the load to truck ratio increased to 35.86, which is right around the weekly average of the prior 2 months. It's definitely a cooling market. Load and truck post volumes both were down 2% and 4% respectively over the same time frame. So taking a quick look at our dry van market condition index, Ken alluded to this a little bit earlier, but some overall macro market indicators. The ATA for-hire truck index for October reported volumes are down 8.7% year over year. FMC reported dry van volumes down 11% year over year. But amazingly, spot market volumes were up 107% year over year, sort of amplifying this imbalanced market we've seen during the pandemic. Last week, pre-Thanksgiving, compared to pre-Thanksgiving week, last week's volumes and rates in dry van were up in most markets nationally. But surprisingly, our number 1 and number 2 markets, usually Los Angeles and Ontario, both those markets dropped out of the top 10 following the surge in imports that we saw in October. So for the first time this year, rates in both of those markets dropped and capacity loosened. In the refrigerated market, typically this time of the year, we start to see produce season wind down. Reefer volumes are down 18% year over year, according to the USDA. That's about half of all of the produce loads moved. Imported produce is only down 6% year over year as we start to bring in more volumes from southern warmer latitudes. And that volume starts to shift from farms in rural areas to port markets such as Philadelphia, Houston, Gloucester, Mass. But unlike in dry van, volumes increased in all top 10 markets, but rates dropped in the refrigerator sector in all but two, and they were Elizabeth and Indiana. Indiana market was interesting. Those reefer rates jumped 13 cents a mile to 261. And then a number one market last week, Twin Falls, Idaho, and the Pacific Northwest, volume started to cool as the produce season winds down. Rates dropped 14 cents per mile to 285. In the flatbed sector, it's definitely slowing down as it does this time of the year with cooler temps. Some macroeconomic indicator last week indicated that manufacturing new orders both fell in November and the pace of the economic recovery slows down. So all of those markets recorded, all the flatbed markets recorded volumes increased last week, but rates dropped in all of those markets. The only exception, again, was the Midwest markets of Little Rock and Memphis. Rates are up substantially in both of those markets where capacity was still tight. In the year-over-year, look at dry van rates. For the first time in nearly 220 days, we're seeing some very slight downward movement in all equipment types. High spot market volumes, but lower overall national volumes, and lack of upward rate pressure could mean that we're reaching an inflection point. We'll have to see what happens in the next few weeks to be definite there. But dry van rates did move down 1 cent per mile to $2.30, excluding the fuel surcharge. Year-over-year comps, rates are up 70 cents per mile compared to this time last year and still at 5-year records for this time of the year. They're still up about $1 a mile since May the 1st when they bottomed out at $1.31. In the refrigerated sector, rates as they do after Thanksgiving began to cool, dropping 9 cents a mile from a high of $2.57 pre-Thanksgiving. They moved down to $2.48 to end last week. Capacity did tighten as it did in dry van, with more trucks posting for loads last week, taking advantage of the higher year-over-year rates. Reefer rates are now 57 cents a mile higher than they were this time last year. And in flatbed, to wrap up the weekly update, flatbed rates decreased slightly by about 1 cent per mile to 2.19. They've been hovering at this level between 2.17 and 2.20 a mile for about 3 months now. Compared to the same week in 2019, rates were $1.77 a mile. So they're 42 cents a mile higher last week compared to last year. So that's it for this week's market update. If you want to find out more about what's happening in freight, go to DAT/resources and download the weekly market update. So that's it, Ned. Over to you.
Hey, before we get to Ned, not to muscle in here, but Santi had a question I thought it'd be better to answer now, if that's all right. A question around import loads, and will we see a big increase throughout winter? And then the follow-up was, would this be good for California? And I thought, Dean, kind of coming on the heels of, hold on one second, we need to get you back up on screen. Sorry for the audible. But you want to take a crack at that? Because I think...
Yeah, I think it's an interesting one, Ken. Typically import volumes start to slow down between now and March. There's a couple of things changing that dynamic this year. I think there'll be a pull forward of volumes. What's driving that comment is the very tight capacity on the ocean side. Spot rates out of Asia are still up around 3,800. Just this week, Hapag-Lloyd announced that they weren't accepting any containers to Europe from Asia because of the strong demand for Asia to the west coast and east coast of the US. So I think what shippers are doing is they're looking to pull forward a lot of that spring volume that they normally do, in the first 3 months. I think they're looking to pull that forward earlier to make sure they've got capacity. So tight capacity on the ocean is going to mean that shippers are going to be pulling forward as much of that volume as they can. Capacity is very tight, rates are high. So I think we'll see some pretty strong import volumes in the East Coast and West Coast. Volumes in Savannah, for example, are up 33% year over year for November. So volumes have been really strong in the port markets, and I think that'll remain the case certainly until mid-February around Chinese New Year.
It doesn't help when over 1,000 containers fall off a ship either.
That was a pretty bad week for the One Express.
Yeah, for sure. Yeah. All right, so with that, I'll turn it back over to Ned. Sorry for the interjection. I just thought that was a great time to get to that question.
No, absolutely. So yes, dry van. Sorry, I got thrown off my game. So we're starting off looking at the dry van forecasts. These are a chart that we like to call the spaghetti chart because off at the right end of the chart, you can see a bunch of different spaghetti from our various models. In blue is the market rate that was observed by DAT at various points. And then our four models are off to the right. We have our ratecast, which is our flagship model in green, our short-term model in red, our blended forecast, which is a mixture of the two in gold and silver. And those are, again, mixtures of the ratecast and the short-term model in different amounts and in different ways. And for the van forecast, you can see that there's a lot of model agreement basically up through Christmas. And then after Christmas, there's a little bit of disagreement, but it's not that strong, where ratecast is expecting there to be a little bit of a bump post-Christmas. Whereas the short-term model is expecting a little bit more flatness with a jump happening right at around New Year. Moving forward to the reefer rates, here you can see one of the weaknesses of the short-term model, and we've had this happen before. The short-term model essentially is not able to completely match the trend of the last couple of weeks because it needs to run alongside for a bit. And so it's not catching that downwards dip. So you see that really big miss in the short-term model. On the other hand, the ratecast model, which works to handle this, is actually handling this, and it's foreseeing a little bit of a dip and then low volume, or rather low rates through about the start of Christmas before this standard New Year pick back up. And the blended forecasts obviously are mixtures of those two. Finally, we're going to be moving to flatbed. Flatbed is another suite of models where we have good agreement through mid-December, and then there's some disagreement with the ratecast model expecting this sort of standard end of year, start of new year flatbed jump, whereas the short-term model expects flatness with a little bit of a downward trend that's very small, and then a jump at around New Year's. So I think that's about it for the forecasting, and it's time to move to the Ask IQ question, which, if I can remember what it is for this week, it is, looking at my notes, how will recent California and Arizona lockdowns affect freight?
That one seems tailor-made for Dean.
I think so.
Yeah, it's a great question. I honestly think that a lot of the pandemic-related responses from lockdowns are already baked into the freight market activity. I think, with the exception of volumes, typically, the trucking industry adapted really quickly. I noticed in about June, July that carriers adapted to the imbalance in the freight market. The contract carriers, by and large, accepted most of their contracted volumes and then rejected the rest, which drove higher spot volumes. I don't see much change other than at a very small market, micro level. You may see some heavy lockdowns impact manufacturers, but a lot of those are still deemed to be essential workers. I talked to some people on the West Coast this week in the Los Angeles market, and they said there'll virtually be no change because a lot of them are essential workers, particularly in the trucking and logistics sector. So I honestly don't think there'll be a lot of change. But what will change, of course, is the buying patterns and the buying channels. So we'll see that typical imbalance occur where consumption goes up as more people stay home and buy online, and production may take a dip. But I think manufacturers and shippers in particular have already adapted to the COVID requirements of spacing out employees and workers, and those production levels will stay pretty much the same.
I mean, not to be like a little gray cloud here, but I feel like shippers have adapted, but the logistics network as a whole has not, and that's why you're seeing a lot of divergence on a lane by lane basis. So, for example, Santi is asking, do you know the reason why California freight skyrocketed from south to north and then plummeted substantially from north to south? Like, these kinds of imbalances people are seeing all over the place. Ken, what's your favorite lane? LA to Denver?
Yeah, I mean, this is perfect. This is what we were talking about before we came on the air, so to speak, right? It's, even if you had zero information on volumes, right? Even if you had no idea how much freight was moving between LA and Denver, and you see $4 a mile from LA to Denver, or it's probably pushing $4 from LA to Seattle, and it's practically free, right? $1 a mile to come back south. That should tell you that there is a tremendous volume imbalance between those trading partners, and you're coming back empty, or you're, hauling empty, just finding some other way to reposition back to freight civilization. So, imports drive a lot of that for sure. Lack of freight coming out of some of those areas drive it as well. I mean, on some lanes like LA to Denver is so pronounced because the import volumes have driven LA outbound up, and Denver out has been down due to just some of the buying pattern stuff. But one side doesn't have to go up; the other could just go down, right? And that drives imbalance. It's like a teeter-totter.
And we've seen that happen, Ken, with if you look at Seattle, Oakland, Houston, Savannah. If you follow where the loads are going in all of those markets, you can see them all heading into the warehouse markets like Stockton, Phoenix. You can see Lexington, Kentucky, for example. There's a lot of fulfillment centers in that particular part of the country because it's close to a lot of the East Coast population. You can see those volumes during the Cyber Monday week, skyrocket as freight was being moved around. So you can trace a lot of this volume. You can see peaks and troughs in markets depending on how a lot of the e-commerce retail freight has been shifting around the country.
Yeah, I mean, I genuinely don't know how they're handling this e-commerce push. I mean, the volumes are just absurd. I mean, there hasn't been even a fractional amount of capacity, kind of macro capacity added from last year's number, and the gross year-over-year change is just wild, right?
Yep.
I mean, FedEx didn't add 100 planes to their capacity.
Yeah, I mean, and I think that's part of the kind of weirdness of it is that some people are adding capacity. It's not like everybody's on freeze, but I think that a lot of people have memories of what happened back during the ELD mandate, where people added capacity and then, pigs got slaughtered. But I don't know.
Maybe to help you give you some perspective, I looked at some of the Geotab telematics data this morning, and it's baselined off the pre-COVID levels in February. But the big split I've seen is the number of trips that light commercial vehicles are doing in that final mile e-commerce space compared to February pre-COVID levels. They're up 200 they've doubled. They're up 204%. So you can see that compared to heavy duty trucks, where those daily trips are only up 30%. So you can see a big shift in the way freight's moving. There's been a lot more activity in that final mile space that's driven a lot by the e-commerce, pandemic related buying patterns that we're all enjoying or not.
So another question we had, and by the way, we're answering questions from the comments and chat. So if you have questions, please feel free to drop them in. Just a question around the January forecast. We started to peak into January, right, Ned?
Yep.
This week. Just given where we are in the year, we kind of made the conscious decision to not alternate right now between the long and short-term forecast. But I think just given where we are in the year, next week would be a good time to show the long-term forecast for the three equipment types.
I think so. I think it's worth, especially since we're going to be going on break, giving people for a couple of weeks. I think giving people some longer-term stuff might be interesting. I think that it's going to be interesting because there's seasonal patterns, but there's also, like we said on the show before, these rates are unreasonably high. And they're obviously not unreasonable because people are doing them, but they're much, much higher than sort of historical precedent for a long time. And we're expecting, or at least I'm expecting, some kind of a correction to come, but when and how is hard to forecast.
I think something that we could do better at internally, right? And this has nothing to do with our products, just I'm talking internally. And I think it's a cautionary tale to anyone who follows the industry or who is active in the industry is, let's just think about if you're a non-asset carrier, aka a broker or something right now.
Right.
Let's just say your volume, and these are just token numbers. These are by no means meant to be actuals. Let's just say that your volumes are up 20%, and rates are up 20%, right? Your revenue stands to be up, Ned.
Well, it would be 140, or
right. I was just joking around, but so whatever. This has a compounding effect. But what I think a lot of folks don't realize is your margin percentage is probably considerably down, right? And you might not have fixed assets, but you have headcount, you have hiring plans and staffing plans that aren't as dynamic. So I think a lot of folks, I mean, just evidenced by the number of inbound requests we have to talk about this stuff, are trying to navigate through this environment where they're getting crazy volumes, crazy high rates, but margins are at 3 to 5 year lows. And that's an interesting three-legged stool to navigate, because you're making a lot less money on a lot more activity. And for an industry that's kind of success is defined by your efficiency,
right?
That becomes a difficult problem to try to solve.
I mean, theoretically, is the reason why you're taking low margins because you can't be as choosy, or just because rates are so high?
I think the most often stated yet most highly misguided phrase in freight, and anyone who's been in the market for a while is going to cringe when I say it, we'll make it up in volume. Right. That's like that's like on the Mount Rushmore of freight fallacies. We'll make it up in volume. So I think, I mean, if you're a non-asset carrier, you're kind of at the whim. You're at the whim of the market on both sides. I mean, I think if you had a really good a deliberate contract hedging portfolio heading into this market, and you were well balanced between spot and contract, you're probably faring better than someone who was entirely exposed to the spot market. But I mean, that's why we're hearing from shippers, which is an interesting perspective, that the response from asset-based carriers has been much more measured, right? Because their cost side of their equation is at least fixed. And they may be coming in with 7 to 10% cost increases, where the non-asset folks are coming in at 18 to 20. And it's not that those non-asset folks are greedy. It's just that their exposure to the spot market is raising their costs at a much higher rate than that truck that's already been bought and is currently being amortized on a fixed note. Right?
Yeah.
So Ned, you want to get us off this onto another question?
Sure. I'm going to ask and answer. Lazara asks, what are some of your predictions for LTL and cargo van load markets, as well as hotshot loads? And I would say that that's something that I would really like to be working on. Currently, we don't have a strong model in place for handling LTL or just other kinds of last mile-ish freight. And that's something that I feel like is increasingly a gap in our modeling portfolio, and I would like to work on. But it's tricky because the data is a lot less clean than other kinds of more standard assets, if that makes sense. So I would like to see that too. And I'm when I have authority and data, I'm going to work.
Well, you are the principal data scientist. In all seriousness, we should add, we're talking about what we're building a show around, or a series of shows around what's in a rate view rate. I'd love to have a conversation with folks in the industry around LTL, because LTL is a completely different animal, right? You introduce freight class, you introduce matrix rating. It's not a rate per mile. It's per 100 weight. So it's a different unit of measure. It's a different rating scheme. You have SAR light and all these other different rating matrices type things. And you have freight class. So even if we set out to just tackle FAK, freight of all kinds, it's not.
It's tricky.
But we should do it, right? We should at least talk about it and see if the juice is worth the squeeze, for lack of a better term. So that's something we'll put on. Let us know. Let us know in the comments if that's something that you'd be interested in. At least having a conversation about in the new year, because I think it'd be really cool to. That one's going to take more of a village, I think.
So we answered Santi's first question about import loads increasing through the wintertime and California-only freight. We've answered Jeremy's question about the January forecast, and James's question about the flatbed forecast. Looks like we have another. We talked about Santi's question. We have a question from Louise. Is there any way to benefit from coming back east to west without driving nearly for free?
So heading from east to west, probably not if there's an imbalance in freight, and that's why you've got to make sure that the rates on the head haul are compensate for the lower rate across the total miles of the round trip. So the other thing to think about is some of the load board opportunities that we've got. Our tri-haul option is very interesting because it'll give you options to build multiple trips into that backhaul. So a lot of carriers, don't look at what I call triangles or quads, where you'll do a straight trip from, say, Los Angeles to New York, but then you might want to build in 4 or 5 individual loads going back the other way to boost the average loaded mile rate. So that's one other option, is to actually look for more opportunities rather than going straight back on that backhaul.
I mean, you're a carrier, so you know this, but one of the tricky parts about that, though, is making sure that you're not wasting a lot of time searching for the next load, or if you've already locked in like the next leg, making sure that you can hit your pickup and your drop off points. And I think that's something that's really challenging. And at least from the data science side here at DAT, one of the things that we're really hopeful that the book it now option and other things like that can work on is making sure that you can get like the next leg and the next leg and the next leg locked in if you're a smaller carrier, and be able to actually take advantage of those tri-hauls rather than those being like a theoretical, you could make more if you did this, but the effort and the time cost isn't worth it.
I think there's a couple things too, just to add, like on the fringe. I think you hit all the high points. Don't look like Occam's razor in a way, right? The best option may be to run for 95 cents a mile back to LA and get a $4 a mile load going somewhere else, right? So, I mean, look at the portfolio of what you intend to do, because the most value, like, I think what we hear for a lot of new carriers, right? It's like, how do I maximize my revenue per mile? It's like, I think, it's your business, right? But our best advice would be maximize your revenue per hour, right? The most valuable thing you have is your hours. As it pertains to like your business. So if you have 2 hour, if you're running 2 hour load and unload times and you want to make 4 stops on the way back to LA, you might be adding, over the course of a month or two, you might be adding 2 less home runs heading back east at $3.54 a mile. So I think understanding it might not look good on paper, but that's a cost of getting back to that extremely high paying freight. And that doesn't apply in every situation, but for sure.
No, but it's the Florida pricing problem, right? Like you have to get the premium on the loads going to the cooler markets to be able to justify getting the backhaul, because a lot of times you just don't have the backhaul. And being able to have not only the market power, but also like the negotiation and the ability to pick your loads so that you can make sure that you're getting paid on the good part well enough to justify the bad part, I think can be really tricky.
Yeah, and last but not least, this isn't a commercial, right? This isn't even our side of the house, but you need a marketplace that has a lot of freight. I mean, if you, especially in a market like this where you may have like had 8 options, right, going as far south as Albuquerque and all the way up to Denver, some of those tri-hauls might not exist anymore, or at least they're no better, right? So why would you go from Memphis to Denver just to get the same 90 some cents a mile to go back to LA? You just drove more miles, wasted 4 hours at a dock at 2 different docks to get the same total rate per mile heading west. But you may be able to find a load to Phoenix and then find that tweener load heading back to LA that averages you out at $1.25, $1.35 heading west, right? So it's important to shop where, you don't want to go to a store that doesn't have anything on the shelf, for lack of a better term. So again, I'm a terrible salesperson, so that was not by end of the commercial. This is like genuine advice.
No, it's true.
A couple more questions. So Stefan asks, do we see more shippers leveraging mini bids to hedge against volatility in these markets?
I'm not a shipper, but I hope so. I mean, like locking in the rates where they are now for a whole year, or trying to lowball things and then having your folks have a hard time getting the capacity that they need to meet your requirements, I think seems like a bad deal. Like if you're...
Yeah, I mean, I think it's happening for sure. I think it's being talked about a lot more as a higher, it's occupying more mind share than it's actually happening, is my kind of supposition, right? It's like big data.
Right.
Everyone thinks everyone else is doing it and no one's really doing it, right? It's like I stood up Hadoop and I have never used it, or something like, you know what I mean? Like, I do think it's happening, but I think to a shipper, even a 12-month bid could be a mini bid if the market flips enough, right? They hold the power to re-put that out or to flex and leverage. So we'll bring that up with when Chris Caplice is on the show with us again.
Yeah.
But
I mean, I remember talking with Chris about rather than doing mini bids, trying to do some kind of like an indexed contract rate. And we've done some research here on the DAT side about like what that would look like and the outcomes of that. But that might be a way that you could not have to deal with rates that you expect to go down, but at the same time for a really long period of time, but still maintain flexibility. But
yeah, I've seen, and I'll wrap up after this. I know that I'm getting the stink eye, the virtual stink eye. But I think mini bids, when I was in the industry, mini bids were not called mini bids, but like they were called project bids. And a lot of times it wasn't due to rates. It was due to the new Xbox is launching, or I have a new mobile phone release. And those aren't lanes that I had paper, or I didn't have a contract with you on. I think that's where they'll settle into their niche. I think the large capacity owners will wise up if every time there's a fractional market movement, there's just a cost to this kind of thing. I don't want to. They're here. It happens. It's a really great tool for really specific problems, but it's not a panacea for market volatility by any means, unless you guys disagree.
I don't.
I think Chris is the one to really kind of spar with on that. And one more thing, we had a couple questions in the chat about IoT and electric trucks.
Yeah.
Another thing to add to our growing list of 21. We should do like a future of trucking and a future of freight. Around all of these ideas, because I think they're super interesting to talk about, and we always kind of get pushed to the back of the line because we're talking about what's happening in the markets now. So Robert and I think Santi asked another one. We'll add that to the list of things to talk about in a future show.
I'm going to wrap this up for this 2000.
We can even talk about Bitcoin. Blockchain. If you find me an expert who actually understands BITA,
I'll call my brother because he was really trying to sell me on it for a while.
I mean, I know my old company had a big involvement with it. So I'd really like to understand, because I guess I'm just not smart enough to understand. Like, I buy into the huge implications. I just don't understand the how. So again, amplification of this thing, guys. So we will be here next week. It will be our last show of the year. There will be festivities all around. There might even be some eggnog and some brandy passed around. I don't want to lose sight of the Freight Vine podcast. Chris has had some excellent guests and an incredible docket for the first quarter of next year lined up. Dean's market reports available on our website, and anything we missed, askiq@dat.com. So with that, we're going to sign off for this week, and we will see you next week. Thanks for tuning in, and hope you have a great rest of your week.
Bye.